Something absolutely extraordinary is happening in the gold market right now, and if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern financial history. Gold just shattered the $4,000 barrier. Let that sink in for a moment. $4,000 per ounce. And here's what nobody's talking about. There's virtually no resistance above this level. None. We're in completely uncharted territory, and the technical setup suggests we're not just breaking out, we're potentially entering a parabolic phase that could redefine what we think is possible for gold prices. But before we dive into where this is headed, we need to understand exactly how we got here, because the forces driving this move are unlike anything we've seen in decades. Let me take you back to early this year. Gold was trading around $2,800, and most analysts were calling for a correction. The consensus was that gold had run too far, too fast. Central banks would tighten policy, real yields would rise, and gold would pull back. That was the narrative everyone believed. They were catastrophically wrong. What happened instead was a systematic dismantling of every bearish argument. One by one, the reasons to sell gold evaporated, replaced by an increasingly compelling case that we're witnessing a fundamental regime change in how the world values gold. The first domino to fall was the inflation narrative. Remember when everyone said inflation was transitory? Then it became persistent. Then it became structural. Now, even as headline inflation numbers have moderated, something more insidious is happening. The purchasing power of currency is eroding in ways that don't show up in traditional inflation metrics. Think about it this way. Your grocery bill might not be spiking like it was 2 years ago, but it's also not going back down. Housing costs remain elevated. Insurance premiums are climbing. Healthcare expenses continue their relentless march higher. This is the new baseline. And once people realize that prices have permanently reset higher, the psychology around holding cash fundamentally changes. But inflation is just the surface story. What's really driving this gold move is something far more profound, a complete loss of faith in the existing monetary system. Central banks around the world have been the biggest buyers of gold for the past several years, but the pace of accumulation has accelerated dramatically. China alone has been adding to its reserves month after month, and these are just the official numbers. The actual amount of gold flowing into Chinese vaults is likely far higher when you account for off-balance sheet purchases and private sector accumulation. Why are they doing this? Because they're preparing for a world where the dollar is no longer the undisputed reserve currency. This isn't speculation anymore. This is policy. The BRICS nations have been openly discussing alternatives to dollar-based trade settlement. Saudi Arabia is accepting yuan for oil sales. The entire architecture of global finance that's existed since Bretton Woods is being quietly dismantled, and gold is the beneficiary. Here's where it gets really interesting from a technical perspective. When you look at the gold chart, what you see is a market that has systematically taken out every major resistance level over the past year. Each time gold approached a round number, 3,000, 3,500, 4,000, there was initial hesitation, some profit-taking, and then a decisive break higher. But now we're above 4,000, and there's nothing above us, no previous price action to provide resistance, no overhead supply from traders who bought at higher levels and are waiting to break even. We're in what technical analysts call blue sky breakout territory, where the only limit is how high buyers are willing to push the price. And the buyers are not retail investors chasing momentum. The buyers are institutions, sovereign wealth funds, and central banks who are making strategic, long-term allocation decisions. These are not weak hands. These are entities that view gold as a permanent portfolio holding, not a trade. Let me paint you a picture of what's happening in the physical gold market, because this is where the real story is unfolding. The London Bullion Market Association, which is the hub of global gold trading, has seen available inventory decline to levels that would have been unthinkable just a few years ago. The gold that's stored in London vaults, which serves as the backing for much of the paper gold market, is being steadily drained. Where's it going? East, to Asia, to the Middle East, to central banks that want physical metal, not paper promises. And once that gold leaves London, it doesn't come back. It goes into vaults where it's held as a strategic reserve, removed from the tradable supply. This creates a fascinating dynamic in the futures market. The COMEX, which is the primary venue for gold futures trading in the United States, has seen its registered inventory, the gold that's actually available for delivery, drop to concerning levels relative to open interest. What this means is that there are far more paper claims on gold than there is physical gold available to satisfy those claims. Now, most futures contracts are settled in cash, not physical delivery. But what happens when more and more buyers start demanding physical? What happens when the paper market, which has kept a lid on gold prices for years through massive short positions by commercial banks, can no longer suppress the price because the physical market is screaming higher? We may be about to find out. There's a historical parallel here that's worth examining. In 1971, when Nixon closed the gold window and ended dollar convertibility to gold, it triggered a gold bull market that saw prices rise from $35 an ounce to over $800 by 1980. That's a more than 20-fold increase in less than a decade. But here's what most people forget about that move. It wasn't a straight line. There were periods of consolidation, sharp corrections, and moments when it seemed like the rally was over. But each pullback was followed by an even more powerful leg higher because the fundamental driver, a loss of confidence in fiat currency, never went away. We're in a similar setup now, except the scale is potentially much larger. The amount of debt in the global financial system is orders of magnitude higher than it was in the 70s. The number of dollars in circulation has exploded. And unlike the 70s, when the United States was still a creditor nation with a strong manufacturing base, we're now the world's largest debtor with a hollowed-out industrial sector. The math doesn't work. Everyone knows it. The question is not whether there will be a reckoning, but when, and what form it will take. Gold is telling us that the reckoning is closer than most people think. Now, if you're sitting on significant retirement savings, and I'm talking about folks with $100,000 or more in IRAs or 401ks, this is something you need to be thinking about seriously. I've put together a comprehensive guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties, and what you need to know about the process. It's completely free, and you'll find the link in the description below. If protecting your retirement savings is a priority, it's worth taking a few minutes to understand your options. But let's get back to where this price is headed, because the technical setup is absolutely extraordinary. When you look at the momentum indicators on the gold chart, what you see is a market that's not overbought in the traditional sense. Yes, prices have moved sharply higher, but the rate of change is actually accelerating, not decelerating. This is the signature of a parabolic move. Each leg higher is steeper and faster than the last. The RSI, which measures the speed and magnitude of price changes, is elevated, but not at extreme levels. This suggests there's still room for this move to extend before we see any meaningful exhaustion. And when you look at the moving averages, every major time frame is aligned bullishly. The 50-day is above the 200-day. Prices are above both, and the slope of these averages is steep and rising. This is what technical analysts call a trend of trends, a market where every time frame from intraday to monthly is pointing in the same direction. These are rare setups, and when they occur, they tend to produce moves that far exceed what anyone thinks is possible. But let's talk about the fundamental drivers that could push gold even higher from here, because the technical setup is only part of the story. The first is the trajectory of real interest rates. Real rates, which are nominal rates minus inflation, are the primary determinant of gold's opportunity cost. When real rates are negative, holding gold makes sense because you're not giving up any yield. When real rates are positive, gold becomes less attractive because you can earn a return in bonds or savings accounts. Right now, even though nominal rates have come down from their peaks, real rates are barely positive, and in many cases still negative when you account for actual inflation rather than official statistics. And here's the key. The Federal Reserve is trapped. They can't raise rates meaningfully without triggering a debt crisis, but they can't cut rates too aggressively without reigniting inflation concerns. This Goldilocks scenario for gold, where rates are low enough to make gold attractive but inflation concerns remain elevated, could persist for years, and during that time gold has a clear path to move substantially higher. The second driver is the ongoing de-dollarization trend. This is not a conspiracy theory. This is observable reality. Countries around the world are reducing their dollar holdings and increasing their gold reserves. The reasons are both economic and geopolitical. Economically, holding dollars means exposure to U.S. monetary policy and the risk of dollar devaluation. Geopolitically, the weaponization of the dollar through sanctions has made countries realize that dollar reserves can be frozen or seized. Gold can't be sanctioned. Gold can't be printed. Gold is the ultimate neutral reserve asset, and in an increasingly multipolar world, that matters more than ever. The third driver, and this is one that's not getting enough attention, is the supply side of the equation. Gold mine production has been essentially flat for years. The easy gold has been found and mined. New discoveries are rare, and when they do occur, it takes a decade or more to bring a mine into production. Meanwhile, demand is surging from multiple sources: central banks, Asian consumers, investors seeking inflation protection, and increasingly, technology applications. When you have flat supply and rising demand, there's only one way for the market to clear: through higher prices. And we're seeing that play out in real time. But here's where it gets really interesting. The gold mining stocks, which typically leverage the gold price, have been lagging the move in gold itself. The major gold miners are trading at valuations that imply gold prices far below where we are today. This disconnect won't last. Either gold prices will come down to justify current mining stock valuations, or mining stocks will explode higher to catch up with gold. Given the fundamental setup we've discussed, which scenario seems more likely? There's another angle to this story that's worth exploring: the role of gold in portfolio construction. For decades, the traditional 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard for balanced investing. But that model is breaking down. Stocks and bonds are increasingly correlated, meaning they move together rather than providing diversification. When both are falling, as we saw in certain periods recently, there's nowhere to hide. Gold provides true diversification because it responds to different factors than stocks and bonds. It rises when confidence in the financial system falls. It rises when inflation accelerates. It rises when geopolitical tensions escalate. These are precisely the scenarios where traditional portfolios struggle. Institutional investors are waking up to this reality. Pension funds, endowments, and sovereign wealth funds are increasing their gold allocations not as a speculation, but as a permanent portfolio holding. This represents a massive pool of capital that's only beginning to flow into gold, and it's capital that's not price sensitive in the way retail investors are. These institutions are allocating based on strategic considerations, not short-term price movements. Let me share a specific example that illustrates what's happening. There's a major European pension fund that recently disclosed a significant increase in its gold allocation. This fund manages over $200 billion in assets, and they moved from a 2% gold allocation to 5%. That's a $6 billion purchase of gold, and they're not alone. Similar moves are happening across the institutional landscape, often without public disclosure. When you aggregate these flows, you're talking about tens of billions of dollars moving into gold, and this is just the beginning. If gold allocations across institutional portfolios move from the current average of around 2% to even 5%, that represents hundreds of billions of dollars of buying pressure. The gold market, while large, is not large enough to absorb that kind of demand without significant price appreciation. Now let's talk about what could derail this move, because it's important to consider the bear case. The primary risk to gold would be a dramatic strengthening of the dollar combined with a surge in real interest rates. This could happen if the Federal Reserve decided to fight inflation aggressively, regardless of the economic consequences, similar to what Paul Volcker did in the early 80s. But here's why that scenario is unlikely. The debt burden today is far larger than it was in Volcker's era. The U.S. government is running trillion-dollar deficits even with the economy growing. If rates were to spike to Volcker-era levels, the interest expense on the national debt would consume the entire federal budget. It's simply not feasible. The other risk would be a deflationary collapse where cash becomes king, and all assets, including gold, decline in value. But central banks have made it abundantly clear that they will not allow deflation. They will print whatever amount of money is necessary to prevent a deflationary spiral. And in that environment, gold thrives. So when you game out the scenarios, the path of least resistance for gold is higher, much higher. Let's talk about price targets because this is what everyone wants to know. Where could gold go in this move? If we're truly entering a parabolic phase, historical precedent suggests that gold could easily reach $5,000 within the next 12 months. That's a 25% gain from current levels, which might sound aggressive, but it's actually conservative compared to previous parabolic moves in gold. In the 1970s bull market, gold rose 800% from its low to its peak. In the 2000 to 2011 bull market, gold rose over 600%. We're currently up about 100% from the lows of a few years ago. If this bull market follows a similar trajectory to previous cycles, we're not even halfway through. Some analysts are putting out targets of $7,000 or even $10,000 for gold. Are these realistic? In a true monetary crisis scenario? Absolutely. If confidence in fiat currencies collapses, if we see competitive devaluations, If the dollar loses its reserve status, gold could go to levels that seem absurd today. But you don't need to believe in extreme scenarios to make a compelling case for gold. Even in a relatively benign environment where inflation remains elevated, real rates stay low, and de-dollarization continues at its current pace, gold has a clear path to $5,000 and beyond. The key is understanding that we're not in a normal market environment. The rules that governed financial markets for the past 40 years, the era of declining interest rates, globalization, and dollar dominance, are changing. We're entering a new paradigm, and gold is the asset that benefits most from this transition. Here's something else to consider. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 80. Historically, this ratio has averaged closer to 60, and in previous precious metals bull markets, it's compressed to 40 or even 30. If silver catches up to gold's move, which it typically does in the later stages of a bull market, we could see explosive gains in silver as well. But silver is a story for another time. Right now, the focus needs to be on gold, because gold is the asset that's breaking out to new all-time highs with no resistance above. Let me paint you a picture of what the next few months could look like. We're heading into a period where several catalysts could converge to push gold even higher. Year-end portfolio rebalancing by institutions, continued central bank buying, potential escalation of geopolitical tensions, and perhaps most importantly, a growing recognition among retail investors that they need gold exposure. When retail finally starts piling into gold, and they always do in the late stages of a bull market, that's when things get really interesting. Retail brings emotion, momentum, and FOMO. They buy gold ETFs, they buy mining stocks, they buy physical coins and bars. And unlike institutions, retail doesn't care about valuations or fundamentals. They care about price momentum and not missing out. We're not quite at that stage yet, but we're getting close. The media coverage of gold's move to $4,000 is starting to increase. Financial advisors who have ignored gold for years are starting to get questions from clients. The narrative is shifting from, "Why would you own gold?" to, "How much gold should I own?" This shift in narrative is crucial, because it's what drives the final, most explosive phase of a bull market. When the question changes from whether to how much, you know you're in the acceleration phase. But here's what you need to understand. This move in gold is not just about making money. It's about preserving wealth in an environment where the value of paper currency is being systematically destroyed. It's about having an asset that maintains its purchasing power when everything else is losing value. Think about what $4,000 gold means in practical terms. It means that an ounce of gold which you can hold in your hand is worth $4,000. That same ounce of gold would have bought you a nice suit in 1920. It would have bought you a nice suit in 1970, and it will buy you a nice suit today. That's the power of gold. It maintains its purchasing power across decades and centuries. Paper currency, on the other hand, loses value relentlessly. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. Every other fiat currency in history has eventually gone to zero. Gold has never gone to zero. It can't, because it's a physical asset with intrinsic value. This is why central banks hold gold. This is why the wealthy have always held gold. And this is why you should be thinking seriously about your own gold allocation. The setup we're seeing right now, gold breaking out to new all-time highs with no resistance above, strong fundamentals, supportive technicals, and increasing institutional and central bank demand, is the kind of setup that comes along once in a generation. The last time we saw something similar was in the early 2000s, and that bull market took gold from $250 to $1,900. We're potentially at the beginning of a similar move, except this time we're starting from a much higher base, and the fundamental drivers are even more compelling. So what should you do? First, if you don't own any gold, you need to seriously consider getting some exposure. Whether that's through physical gold, gold ETFs, or mining stocks depends on your situation and risk tolerance. But having zero gold exposure in this environment is a bet that the current monetary system will continue to function smoothly, that inflation will remain contained, that geopolitical tensions will ease, and that the dollar will maintain its dominance. That's a lot of things that need to go right. Second, if you already own gold, this is not the time to be taking profits. Yes, gold has had a big move. Yes, it could pull back in the short term. But the bigger picture suggests we're in the early to middle stages of a major bull market, not the end. Taking profits now would be like selling your tech stocks in 1997 because they'd already doubled. You would have missed the most explosive part of the move. Third, pay attention to the mining stocks. When they start to catch up to gold's move, that's when the real money will be made. The leverage in quality mining companies during a gold bull market can be extraordinary, but you need to be selective. Not all miners are created equal, and in a rising gold price environment, the companies with the best assets and the best management teams will dramatically outperform. The bottom line is this: gold is setting up for a parabolic move, and we're watching it happen in real time. The breakout above $4,000 is not the end of this move. It's potentially just the beginning. The fundamentals support much higher prices. The technicals are aligned. The institutional money is flowing in, and retail hasn't even shown up yet. This is the kind of opportunity that defines portfolios and creates generational wealth. But you have to be positioned for it. You have to understand what's happening and why, and you have to have the conviction to hold through the inevitable volatility that comes with any major bull market. The gold market is telling us something profound about the state of the global financial system. It's telling us that confidence is eroding, that the old rules no longer apply, and that we're entering a new era where hard assets will outperform paper promises. The question is not whether gold will go higher from here. The question is how high it will go and whether you'll be positioned to benefit from what could be one of the most significant wealth transfers in modern history. The setup is clear. The opportunity is now, and the clock is ticking.